Welcome, and thank you, Thomas, for the introduction. My name is Bjarke Smith-Meyer. I work at POLITICO. I'm the fintech correspondent over there now, and I'm delighted and honored to be talking about how the anti-money laundering package is going to impact crypto, and I am super honored to have such amazing panelists with me here. Thomas gave you a very quick introduction, but let me just do it again, just so that people know exactly who's who, and then I could ask my panelists just to raise a hand so that everyone knows who the individuals are. We have Crypto.com's head of policy for EMEA, Roeland Van der Stappen. Hopefully I pronounced that correctly. Beautiful, okay. Then we have Coinbase's director of financial crimes and legal affairs, Rabenn. TRM Lab's senior policy advisor, Isabella. And last but not least, the European Commission's deputy head of financial crime unit, Claude Bocqueraz. Hopefully I pronounced that okay too.
Perfect.
Oh man, I'm off to a flyer here. Please, ladies and gentlemen, give my panelists a warm round of applause so they feel welcome. Thank you so much. I should also remind you that this is an interactive panel, so if you do have burning questions for our panelists, then you can always write it into Slido, and then I will see it up on my screen here, and I'll make sure that we get some of the relevant questions in. If you go completely off course, I will probably ignore it, just so that you know. I think, obviously we're talking about how this AML package is going to impact the crypto industry, but I think it's worth us reminding ourselves how we actually got here in the first place, and that's why I'm so happy that Claude is here from the European Commission to take us back to the summer of 2021 when the package came ahead. Claude, can you just tell us a little bit, why was it that the Commission actually introduced this package in the first place?
Okay, so it all started with a diagnosis. We've seen many cases involving European institutions, important cases which showed that the European Union had a problem in its capacity to prevent that its financial system was used for illicit purposes. And that diagnosis was shared by the member state, all the member states. They urged the Commission to act in their Council conclusion of 2020. And that diagnosis was also shared by the European Parliament, which had adopted resolution urging as well the Commission to act. And one of the observations that was made in this diagnosis was that the AML framework, the legal framework in the Union was too fragmented, was scattered, because it was mainly relying on a directive. And the directive means that it has to be transposed in national legislation. And the way it was transposed involved differences and delays between the member state and delays in the implementation by the member state. And that's why we decided to propose, I go back to the legislative package that was adopted a year ago, not only a revision of the existing directive, but a new directive that is mainly addressed to the public authorities, and also a new regulation that is addressed to the private sector, as well as a recast of the transfer of fund regulation and a regulation that would create a new authority, AML authority, to help member state and the private sector to apply consistency rules.
Okay, so just to kind of wrap that up in sort of true journalistic style, we had pretty terrible harmonized AML rules, which allowed for a whole bunch of banking scandals, ABLV in Latvia or Danske Bank in the country that I know best, in Denmark, and we didn't have a AML watchdog, so that's what we mean by AMLA, an anti-money laundering authority. So we relied on the SEC and the American authorities to basically do the supervision for us on a cross-border basis. That's part of the cynical journalist approach of this. One of the things that was not in the scope originally when this package was put forward was crypto. Can you just tell us how we got around to the point where now we are talking about supervising crypto as part of this?
Okay, so I need to make several points on that. First of all, the crypto sector has significantly increased since that process started and today, because that process started around 2015. Second, we've also seen important, so the sector itself developed and its exposure to money laundering and the financing of terrorism increased as well. That was one point observed in the European Union and reported in what we call national risk assessment and supranational risk assessment. Second, there were developments ongoing at the international level. And the FATF, so the global standard setter in the area of AML.
The FATF is the Financial Actions Task Force,
Yes.
the world's anti-money laundering watchdog, if you like.
Adopted standards obliging jurisdiction all around the world to regulate from an AML perspective virtual asset providers, and also adopted another recommendation, which was requiring that traceability of transfer of crypto asset had also to be introduced in the different jurisdictions. So there were also evolution at the international level. And the third point also is that whilst the Commission was working on this new AML package, the Commission was also working on MiCA. So we had the legal framework to scope in a certain categories of obliged entities, CASP.
Great. No, well, let's add a little bit of more context to this. I'm thrilled that we have a blockchain intelligence and analytics company in Isabella. Can you just give us a sense of just how much dirty money there is in crypto?
Sure. Excuse me, and it's thank you so much to Blockchain for Europe for inviting us to be here today. When we try and determine how much illicit activity happens in any financial product, it's always difficult. We only really can detect what we know about. But I think when we look at the sort of what is the consensus amongst the industry of how much illicit activity we see, it's roughly under 2%. And what you'll often hear about traditional finance is that you're looking between 2 and 5% of global GDP is laundered or involved in illicit activities. So it's roughly comparable between traditional and crypto. What does that illicit activity really look like? Well, just to speak to a couple of trends that we're seeing at the moment in 2022, I think the biggest theme in illicit activity is DeFi hacks. So at the moment, it's been a pretty tumultuous month for hacks. But in 2022, we've seen about $3 billion of finances taken from hacks, and that the actors behind those hacks range from, to some extent, North Korean actors, other state-based actors, but then also your more traditional, so just black hat hackers. In terms of other trends, crypto has always supported darknet marketplaces, which is quite a unique part of the crypto ecosystem. And as of this year, we've seen about $870 million worth of funds move through dark marketplaces. And then finally, and I think what we hear about quite a lot in the press in terms of illicit finance and crypto is the huge amount of frauds and scams that target retail consumers. And in about just 3 months of 2022, according to TRM's research, between June and August, about $93 million were reported to have been taken from consumers in frauds and scams. So there is some illicit activity, we can't deny it. Some of that is quite unique to crypto, like darknet marketplaces, but a lot of that also is quite similar to what we see in traditional finance as well.
Okay, so a little bit of dirty money there, but the bankers seem to be the best at laundering dirty funds. I hope there are any kind of bankers out there. Anyway, Claude, it might be a bit of an obvious answer to some AML experts, but could you just explain to us and the audience, what does it mean then for a crypto company to be an obliged firm? I mean, can you just give us a sense of what are the duties they would have to do as part of that?
Yeah, let me apologize for the jargon that we use. Well, with this new regulation that the Commission has proposed, all CASP, so as defined in MiCA, will become what we call obliged entities, which means basically that they will have to comply with rules that the rest of the financial sector had to comply up until now. And those rules that crypto asset service provider will have to carry out a risk assessment of their activities, understand where the money laundering risks are, put in place procedures, controls, and document them. Next to that, they will also have to carry out due diligence. So when they have a customer on an occasional basis or when establishing a business relationship, they will have to understand who is in front of me and identify who is the person, who is the beneficial owner of the person that is coming, monitor the transactions that are carried out by that person, and see whether the transactions that are carried out by the person are consistent with its identity and the purpose of the business relationship. And last, keep a track of that so that if there are suspicious transactions, they are reported. There's an obligation for obliged entity to report suspicious transaction to financial intelligence units, authorities. And even when not reported, keep a track. So in case they are asked, they can provide the information. That's what it means to be an obliged entity in the private sector.
Roeland, let's come to you. This seems fair. No, same risks, same activity, same regulation. No?
I think first of all, we prefer to have the same, strive for the same outcome. Obviously, having effective AML KYC policies in place is key for our long-term success. I think when designing a regulatory framework, we also need to reflect on how is crypto different than existing financial system, and then see how rules should be adapted. And I think you can kind of see three main differences between crypto and the traditional financial system. And obviously the main one is on the infrastructure layer, also the way we set up, and then by the sheer global nature of many of our the firm's activities. So if I take them in turn, I think it's maybe fair to say that the existing rules have been written for the traditional financial system, where transactions data is recorded in private service that sit across multiple companies and jurisdictions. Then if you turn to crypto, all of the transactions and data are recorded on the ledger that is shared, transparent, traceable. So in a way, the AML risk should be lower than when data sits within silos of individual financial institutions, and you can kind of investigate and go back to the origin of funds. But because data is on the public ledger, there's also, we think about differently, maybe about financial privacy. I'm sure we get back to that later. And there's also an opportunity to have more of a risk-based approach. So that's why we will use firms like DRM Labs and others. I think another way where we're different and where we also like really welcome the AML package is you can think of a CASP like ourselves as similar to a digital challenger bank, in that we use the latest RegTech solutions for KYC onboarding, for our risk management purposes, in that we're digital only and we are cross-border. So we very much like to have that single rule book, because even though there is MiCA and we're moving towards a single market, we still have to comply with different rules in different European markets. And I think the last point, I think that's also something that regulators picked up on, is crypto by nature is truly global. So for us, it's key. And I think that's always the first point, that you have a consistent implementation of the rules that we have in place. You're only as good as your weakest link, right? We can have the right KYC policies in place or comply with travel rule, but if there are players in certain jurisdictions that are not on the same page yet, that poses a risk. So that's also why we kind of very much welcome this global regulatory approach to our industry.
We'll get to the travel rule soon, and don't worry, I haven't forgotten you, Grant. Soon you will get a chance to speak, so just making sure that you don't feel too alone there. But I will jump to Isabella quickly first. No, I mean, can you just tell me? I mean, how does blockchain make the crypto industry different, or is Roeland lying?
No, I mean, I completely agree with Roeland. You make some excellent points, but someone put it really well to me the other day about what makes crypto so unique when you think about tracking criminals. Imagine if you took a 20-euro note out of your pocket and you took the serial number and you could put it into a search engine, And that search engine would return to you every single pocket that 20-euro note had ever been in. You would understand so much more about criminal typologies of cash-based money laundering, which is a huge problem, than we can do currently. So, one of the things about the blockchain is the transparency that you speak of. It allows us to really, really understand where are funds moving. And we just couldn't do that before in traditional finance or in places where we rely on entities reporting. In addition, also, because it can't be changed or doctored, we also remove the issues around discrepancies in reporting. So, hurdles in financial investigation can include reports going completely missing, maybe by coincidence, maybe by mistake, or being changed. And those are three really considerable challenges in traditional finance we just don't see in blockchain. And of course, being from TRM Labs, I have to make a shameless plug. In addition to overcoming those,
I did not get paid for this.
those challenges, we can also take raw blockchain data and layer it with enriched insights, structured in a way that it makes it much easier to follow the money, really add on open source intelligence, thinking about like what are ownership and governance structures like at VASPs? How can I improve my due diligence models for complying with various elements of the AMLRs? And also, can I proactively go out and look across blockchains using threat intelligence to understand some of the illicit activity that's happening? So I think there are huge opportunities that come from the blockchain, mainly in overcoming those quite basic financial investigation hurdles, but then also in the way that this is an open source database that we, by applying analytics to, can get really clear and clear insights so we can be really confident in to understand how illicit actors could be exploiting this technology.
Yeah, thanks. Well done for getting your plug in.
Thank you.
Let's jump to Roeland mentioned very briefly the travel rule, and I'm gonna let Grant talk a little bit about what Coinbase is doing in order to implement this. But before we do that, I mean, travel rule to some people in the audience might not mean anything. So again, I'm thankful that we have Claude here just to explain to us what it is that the travel rule is supposed to do.
Okay, travel rule again is a terminology used by the FATF, jargon again, in the sector. What it means is very simple. The traditional sector has the obligation since several years already, when they carry out a transfer of funds, to identify who is the payee and who is the payer, and keep that information. Basically, what the recast of the transfer of fund regulation is doing is extending that obligation, the travel rule, to CASP. So CASP will have to identify who is the originator of a transfer of crypto asset and who is the beneficiary. That's about it.
Did get controversial because there was suddenly this idea of roping unhosted wallets or self-hosted wallets, depending on how people feel about naming this, into the rules. Can you just explain what it was that co-legislators in this town ended up agreeing on?
Sure. The co-legislators have been very ambitious and have reinforced what the Commission proposed. Basically, what they decided regarding self-hosted wallet is the following. When there's a transfer involving a self-hosted wallet, the CASP has also the obligation to collect information on who is the owner of that self-hosted wallet, and has the obligation also to make an assessment of the risk. And on the basis of that assessment, decide which risk mitigating measures to implement. And one of them could be to check the identity of the beneficial owner. That was a point that was discussed by the co-legislator and is in their political agreement. Yes.
Thank you, Grant. As I promised, I would come to you. Could you actually just enlighten people and explain to them what a self-hosted wallet is, and then tell us how Coinbase are going about implementing the travel rule?
Yeah, happy to. So you've heard maybe unhosted wallet, and now we've discussed self-hosted wallets. I'm going to recommend we actually just call them personal wallets, because that's what they are. We've landed on this really jargon-esque, technical term that's now being thrown around, and it's turned into a Frankenstein monster, in my view. Let's just call it a personal wallet. You have a personal browser to access the internet. You have a personal pizza. It's not a self-hosted pizza. Sorry, I use that joke every time.
It works well. Yeah, you did well.
And it's a personal wallet, right? This is your ability to interact with Web3, right? It's the method by which you're going to store assets. You're going to access decentralized apps. You're going to prove who you are through decentralized identity. And so to shoehorn this idea of a wallet into this technical term, I don't think makes sense. And actually, if you think about what a wallet is, it does more than just store cash, right? You have not as much, but we used to carry pictures of our family. Now they're on our phones. You have identification documents. You do lots of things with a wallet. It's the same with a personal wallet. So that's what we're going to advocate for, personal wallets. It brings it back down to earth. Now, there's not a technical definition about what a personal wallet is. It's a functional definition. If I have a wallet and then I give my private keys to an institution, it suddenly becomes a custodial wallet, right? So technically, there are various types of wallets and the ways they're used. There's cold storage, there's hot wallets, there's all these different ways in which they can be used. But fundamentally is, do you control the private keys, meaning the password, to use that wallet to interact with blockchains? So that's fundamentally what a personal wallet is.
Thank you for that. And could you then explain how Coinbase are going about implementing this through the trusts network?
Yeah, so just stepping back and I want to think about what was the point of the travel rule. The core point was that when law enforcement wanted to get records, they would issue a subpoena to Bank of America, and then they'd say, well, where did this come from? And Bank of America would say, well, sorry, you have to go to Citibank to get that information about the originator. And so the whole point of the travel rule was every institution has to maintain information about the flow of that transaction to simplify the law enforcement and regulatory process. Okay, that was the core point, just to kind of put it into context. Travel rule now, at least in Europe, encompasses two things: transfers between regulated CASPs, but now this somewhat bastardized version of the travel rule, which is you're not going to actually send funds, but now you have to collect funds, CASPs have to, on transactions with self-hosted wallets, right? So we've kind of taken the travel rule, and the whole point was the funds travel and information travels with those funds. But now it's just a collection requirement when it comes to transactions with self-hosted wallets. So it's not really a travel rule, it's just a collection rule. And we have objections to that, but we are where we are, so I don't want to have to relitigate it. But in terms of solving for the travel rule itself, which is a transaction between Coinbase and Crypto.com, is it started with the US, and FinCEN said in 2019, the travel rule is going to apply to crypto firms. The great thing, though, is that FinCEN didn't say, here's how you're going to do it, do X, Y, and Z. Rather, they said, industry, here's a regulatory problem, you go solve it. And that's what the industry did. So the leading exchanges in the world got together and said, how are we going to deal with the issues of applying the travel rule to crypto? And briefly, those are two core issues. One, how do you identify your counterparty? Because it's not readily apparent with crypto, whereas opposed to SWIFT transactions or FedWire transactions, it's built into the process. You know who you're sending funds to. And secondly, how do you then transmit that data from Coinbase to Crypto.com? So we developed a solution called Trust. It's a travel rule universal solution technology. It's a nonprofit industry consortium whose only goal is to comply with this simple but at the same time complicated regulation. And so we have over 50 or 60 unique members at this point. We've launched in Europe. And we hope to really act as the SWIFT for crypto. But I think the lesson to take from this for regulators is let's first consult heavily with industry and see if we can identify a problem and see how industry can help work with us to solve it, rather than unilaterally saying, oh, wow, there's this rule out there, it has to apply to crypto, without thinking about what was the original rationale for the rule. Is it solved for in a better way in this new context of public ledgers?
I'm going to come back to you on the privacy or the collection aspect of it. But before I do, Roeland, I mean, you also have some concerns about how you go through the point of verifying someone's identity when it comes to your personal wallet. Seeing as Grant's sitting next to me, and he might slap me if I say anything else. But Roeland, can you just explain, like, what are the concerns there about verifying the identity?
I think first is also a question of whether it's technically possible, because if you don't have a commercial legal relationship with someone, it's impossible to kind of verify that individual. So I think that's also where then we landed in the DFR, saying you have to kind of have proof of ownership of the personal wallets of the individuals that are your customers, and have a risk-based approach to for transactions from personal wallets from individuals that are kind of third parties. But that risk-based approach still remains to be determined. So that's where we will probably all watch closely, and I actually are quite happy to see the EBA already setting up expert groups to kind of advise on what a risk-based approach could look like, and it's something that we would prefer rather than verification of identity, given that, you know, if you can search all transactions and can put a name to it, that raises questions of financial privacy. And I kind of like and agree with the analogy of a personal wallet, and you can kind of even go a bit further, because our company's view has always been that the travel rules should only apply to transactions between CASPs, like regulated entities similar to the banking space, and that the wallet is kind of like a cash withdrawal. It's money in the pocket. But what it's different if I go across the street, take 50 euro out, go buy a coffee with my cash, it's not traceable. Whereas with personal wallet, the cheaper wallets, transactions are still on the ledger. So I think the risk-based approach from our perspective remains justified and welcome. I think there's also another implementation challenge that we see, and that also will depend on where we land on the level 2. That's the requirements to only send the information required by travel rule to a CASP that is GDPR compliant. And I think initiatives, and I have to compliment Coinbase for kind of spearheading the trust initiatives where you bring together other industry participants, kind of will enable the kind of identification of CASPs that are maybe like GDPR compliant, but not everyone is part of that initiative. And firms like ourselves won't have the depth to kind of analyze the data policies of every individual CASP out there. So I think we will maybe see a risk-based approach, and then welcome further guidance from the EBA and the European Data Protection Board in time.
Just to explain some of the jargon, the EBA is the European Banking Authority in Paris. I guess you've booked your ticket to make sure you knock on their door and get your point across.
Exactly.
But before I jump to Isabella to talk about how the UK have gone about introducing this travel rule, I mean, Grant, you know, as we mentioned, this is about collecting information. And then as Roeland just mentioned as well, there is a sort of GDPR component to this. And for those that don't know, that's data privacy protection. I mean, you have also some concerns over the privacy side of this from a GDPR point of view too, as well.
Yeah, I think, unfortunately, the anti-money laundering world doesn't always communicate with the privacy world. I think they're two very important regimes. And are at times conflicting. I think often there are technological solutions to prevent those conflicts from happening. But with the case of TFR, I don't think it was necessarily fully contemplated. What does this look like in actual implementation? And if you think about it, what this means, because we're dealing with this as a CASP, is if Coinbase has a customer who's sending funds to a personal wallet, that owner is most likely not a customer of Coinbase's. Well, how do you get that information then? There's no travel rule system that you can apply because you're dealing with an individual. So what do? Well, we ask our customer, who are you transacting with? They say John Doe with address of 555, White House Boulevard, and we're stuck with that data, right? You cannot verify that data, because the owner of that wallet is not a customer of ours. So we have no contractual method by which we can compel them to provide that information. If we were to try to verify it, they could say, well, sorry, that's not the case. And then we would have to go to our customer and say, essentially, you can't send those funds now then to that personal wallet through no fault of their own, right? I think there's this idea that if you can't identify your counterparty, there's something illicit that's happening. But think about all the transactions, maybe the majority of transactions you carry out on a daily basis, you could not name your counterparty, right? Anything that goes through a merchant, let alone smart contracts, which I also don't think were fully contemplated, but there are, at least especially in crypto, a lot of transactions are being facilitated through smart contracts, in which, once again, there's nothing wrong with the fact that you don't know who your counterparty is. It's just not part of the way in which you're transacting. So I think what this means is that if you're going to verify, essentially a firm has to limit that transaction to a first party send, meaning my customer, John Doe, can only send to their own self-hosted wallet. What does that mean? Well, it's actually bad overall for visibility for law enforcement and regulators and exchanges to some extent, because if John Doe is going to send to Jane Smith, he's going to still send the funds to Jane Smith. It just means first he has to send to his own personal wallet, and then he has to send to Jane Smith, which means we've increased the amount of paperwork, the amount of compliance resources we have to spend on this. We're now collecting additional information about a third party, but really for no intelligence gains whatsoever. And in the end, if a bad actor wants to provide us with information that's incorrect about their third party, because there's verification only for high-risk transactions, you're going to be getting lots of bad data being ingested by firms that will then come out in the form of suspicious activity reporting and other things. So I think a lot of this wasn't necessarily contemplated at a practical level as to how this was going to play out. But once again, I don't want to overly litigate this. I think one thing I want to flag is that there are also proposals now that are out there. I think the Commission's AMLR proposal, Article 58, discusses prohibiting CASPs from being able to offer personal wallet software. So I think this is, because TFR is what it is, we landed where it is, I think our focus now should be, let's try to make sure we have proper industry consultation to think about what are the practical impacts of requiring, for instance, regulated MiCA CASPs to not be able to offer also personal wallet software. So that's what we're trying to say. We need to start thinking about the practical implications, the privacy concerns, the consumer protection concerns.
It always impresses me when people can pull out exact articles in a piece of legislation. So well done on that. The AMLR is the single rule book that is one of these. Before I let Claude deal with all of this, the one thing that I do want to bring to everyone's attention is that the UK has taken a slightly different approach on how to develop the travel rule. And Isabella knows a little bit about that. Can you just explain how they've taken a different approach to the way that the Europeans have?
Sure. So over the last year, the UK consulted extensively on the travel rule and other amendments to our money laundering regulations. And we differ in the implementation of the travel rule in three main areas. I'll start with the issue of unhosted wallets. So following consultation, it was felt, as Grant alluded to, that actually there isn't a huge amount of evidence that the activity that goes through unhosted wallets is majority illicit. And so it felt that it wasn't proportionate to include them within the UK's implementation of the travel rule. And also, as Grant said, there are many very legitimate uses for unhosted or personal wallets. So what the UK has decided to do is to take a risk-based approach to imposing the travel rule on personal wallets. And when there is an elevated risk of money laundering, that is when the travel rule will apply. Now, of course, that does mean some form of due diligence has to be performed to identify whether or not there is that elevated risk due diligence. So this is not a travel rule free area, but it is definitely much more risk-based, and how to identify those elevated risks will also be set out in legislation. Two other areas that the UK transposition is a bit different. We will be having a de minimis threshold of €1,000, not pounds, to when the travel rule applies to transfers. And then finally, there's a bit of a funny exemption for domestic-only transfers, where if you're transacting between UK entities, less information has to be sent, but that information needs to be stored and made accessible to law enforcement agencies. So those are three slight differences. Also, our implementation date is slightly different. So this goes live in the UK from the 1st of September 2023, and we are hoping for guidance ahead of that from Treasury, but we'll see. Hopefully mid next year.
Okay, Claude, you ready for this?
Yeah, well,
Well, I'll lay it out for you just so you really get the point here. So, not only is TFR or travel rule awkward to implement, there are privacy concerns, but worst of all, the British are doing it better. Can you please address
not
all
say
of these
that.
concerns
Yes.
and take us home?
Yes.
Thank you.
No. We've been discussing when the travel rule was scrutinized by the co-legislator with you all. So we've discussed all those concerns, and the co-legislator were also very aware of the difficulties in terms of implementation. That being said, TFR is not rule-based. I mean, it's implementing in EU legislation the travel rule, something that all jurisdictions across the world have to comply with. So that's what the UK did it as well. Beside the fact that there are risks, and those risks need to be mitigated. So in the EU legislation, it's also very much risk-based. I want to insist on that point because I hear again and again that there's a requirement in the case of a transaction with a self-hosted wallet or personal wallet that there's a need to collect and verify the information. Again, it's risk-based. What the rule says is that you collect the information, and based on your risk assessment, you decide whether you want to verify that information or whether you're going to carry out another type of due diligence measures. So that's the first point. The second point, and I come to the implementation point, there were discussion around what the technology is going to offer, is already offering and is going to offer in the coming years. And that's why TFR mandates EBA, European Banking Authority, to prepare guidelines. And those guidelines will have to be ready more or less 1.5 years after the law enters into force, and expectedly it should enter into force at the beginning of next year. So this gives a bit of time, and EBA will consult the industry because the purpose of guidelines is to consult industry and build something with industry, with stakeholders on the basis of rules that have been adopted by the co-legislator. Now, if I need to make a comment on the UK legislation, I don't think we're apart. I rather think that we converge. The regulatory and supervisory approach have been culturally different, but I think in spirit we're very close to each other. And now I should add the last point. Sorry to be a bit long. Also, there are many review clauses in the TFR and in the package in general, and the Commission is expected to come 1.5 years after start of application with a report, an assessment of about whether the rules work or do not work. So I think, I think we are all the institutions, the Commission when it prepared that, and accompany the co-legislator, and the co-legislator have been very mindful of what the industry was saying.
And with that note, I thank you all very much. Do stick around. We're going to have the next debate on crypto taxation. It's a great topic for all. The tax man is very popular here. Ian Taylor will be handling that. But for now, please thank Claude, Isabella, Roeland, and Grant with a warm round of applause. Thank you all very much.